Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, January 26, 2022. I'm going to do a quick update on the markets and just another reminder that today is the big anticipated FOMC announcement, 2 p.m. today. You want to hear what the bobbleheads have to say. They'll parse through the statement and pick it apart. You can either check it out on CNBC or Bloomberg right after the announcement, or if you have Thinkorswim, TD Ameritrade's Thinkorswim trading platform, they have if you go in there, you can look at you can pull up a CNBC screen on your monitor, a little window for CNBC, and listen to what the rate decision is, and then after that you're going to hear everybody give their 2 cents on whether they think it's hawkish or dovish. And here's the thing: is first and foremost, the important thing is the market's reaction, not what Powell does or says. And also keep in mind the initial reaction, I say this every time we have a big meeting, is often not the one that lasts. In other words, it's more than common to see the market spike up sharply initially or drop down only to see that reversed, and then sometimes that reversal is also reversed. So the takeaway is this. I mentioned yesterday in one of my comments to a question in the trade under yesterday's post about trading around FOMC day, and I feel pretty strong in this. If you're not a very active, nimble, experienced trader, best to just stand aside, let the dust settle, and also define your trading style and your time frame. So I'm going to speak to swing and trend traders today on levels to watch, and how to maybe position afterwards or even before. It's just simple. You're going to see volatility again, post FOMC volatility. I tend to also pull stops on that day on any positions that are nearby a stop loss order. But if they're near a sell limit order, I want that to happen. In other words, let's say I took XYZ stock, right, and I have a price target right here, whatever that number is. We'll just use this chart when we're on SPY chart. But let's say my price target is at 390, and I have a stop down here at 370, and the Fed announcements here. I may suspend the stop because the Fed's gonna, the stock's gonna do this after the Fed. I may suspend the stop, but I'll leave the price target in place, because the goal to any trade is to hit your price target, right? So I want to use that volatility to my advantage if it pops it up and hits my target. However, I don't want to be whipsawed out and take a loss. So and it's a strategy that can cut both ways. If it just keeps going down, then sure, you've suspended your stop, and now you're going to have to stop at a lower price. But over time, it's helped me out. So again, that's anything anywhere near the stop. If it's not, don't worry about it. Stick to your plan. All right, let's talk about levels to watch and things that may happen. So again, the market's going to react however it's going to react, and the initial reaction probably won't be the lasting reaction. It could be, but we'll know. Well, we'll certainly know by next week. Sometimes it takes a day or two for the noise to abate. Here's the levels to watch. I'm going to make this very simple. Whether you are a bull or a bear, well, at this point in time, I'm not speaking perma-bull, perma-bear. I'm just talking the next, let's say, several weeks or the next 10+% in the market that you plan to trade. Do you think it's going to be up or down? I still think down some, but I'm going to give you levels to watch. All right, so on SPY, this is a daily chart. We hit this target here on the downside. I had a second target. This was really the first target. Again, depending on where you entered, it could have been the first target here, but these were the targets I laid out. That was the key level where the dam broke. So that helped give me, additional check marks, some pretty strong ones when we broke these recent trading ranges. And then we went on. We took out the 200-day moving averages, which I said would be unusual to see. It's like a game of Monopoly. Do not pass go. Don't click 200. Whatever. They rarely just keep on going through there and never look back. So there it is. We got the back test. I mentioned that if you wanted to bounce trade it, you could swing up, and those would be price targets. Let me turn them up a little. There's the 200 simple in blue, and here's the exponential in red. And so that's it. So we went down, broke support, had a very impulsive drop, and we back tested now those 200s. Remember, they act as support on the way down. Usually in a waterfall sell-off, you're going to have that momentum fueled overshoot. That's more than common. And then once broken, they act as resistance. So the takeaway of this video is This right here, where we just hit right now, this is this morning's candle. We kissed or close enough to the 200 simple. Again, you don't have to have a perfect tag. In fact, if all eyes are looking at a level, then it's more than common that the sellers may step in early. So just like I like to take profits a little before the actual resistance level on a long trade, same thing if I'm looking to short. So this is an objective short here on that pushback to the 200. Yeah, the Fed may make some volatility, but again, if you position here and you're swinging for the next target down here at about 411 in SPY on the daily, and I'll get, I have different targets or similar ones on the weekly. I'll get to that in a sec. Then you can allow, what is that? Let's say you short here right now at the 200, and you're looking for, and again, if you're trading SPY, 7% drop. Well, you can easily allow this a little better than a 2%, maybe even a 3% stop loss. Yeah, I think 3% works on that case because that's still a decent risk-reward ratio. And then the other level, if something goes in the favor of the markets, this is a great, very objective level to short, 450, if we happen to get back there. I'm not even going to speculate. I'd say the odds are a little under 50%, but they're measurable. I'd rather be short here, add back swing shorts than wait there. But I'll tell you what, that would be a layer to level to add additional short exposure. And then look, you got to give it some room. 450, 375, 454 is support as well. Remember, in times of high volatility, you're likely to overshoot a resistance level. So your stop should be somewhat above that level there, that 454 level. Again, if you're swinging down. And remember, I still have longer term targets. I still think SPY will come down here at least 397. That's the daily chart. On the weekly chart, I have targets all the way down potentially to 354 or more. We'll just have to see. We'll need a few more check marks. We'll need the long-term trend indicators to roll over. But right now, we're below those 200-day moving average and that 40-week moving average there. So that's it. I don't want to beat a dead horse. This is an objective level to short, and any pushback up to those recent trading ranges will be as well. QQQ. This would mesh with a back test of that level on SPY. QQQ sliced right through the 200s. They had a little reaction for a day or two on there, parked it one day, next day traded and even had a bounce through it, but finally gave them up. So the 200s, as you can see here, I'll tell you, they come in around 366 on the simple, down to about 364-ish on the exponential. They're really close together, and that would be also an objective level to add short exposure if we get a bounce up there. We're at resistance now, 351.68, and then the max bounce target. Again, we have the yellow lines, which are very important support. You have a resistance zone here from about 373 to 378. Certainly some resistance above that, but that's really, if we get up there, it's going to take the SPY well within its trading range. But that's my max bounce target right now, and that's where I'd really allow shorts up to about here, about 382.80. We'll call that 383. Anything above there for the long-term trader targeting my deeper targets on the weekly chart. That's it, and that would be you're going to have to ride out. And this is why you may want to go easy into the Fed, see what happens, and then add to, take a partial short position and add to it depending on what happens. Again, bounce back to resistance or break of the lows. I'm talking about potential bounce targets, but just to put it in perspective, again, that's better than the 8%. Bounce back. Now there were plenty of opportunities, and my preference for active trader was to take cover shorts there and play the bounce long. So everyone's entry price is different, their average cost, so therefore your stop is going to be different from somebody else's. So this is just levels that if maybe you have no position at this point in time, these are levels to watch. Again, the 200s and then the bottom of those ranges. Just remember that if QQQ takes out the 200s and moves up to the bottom of that range, it's going to put SPY well back within its trading range. And we're also going to watch the weekly charts. This is where things really need to change my outlook as to where I think we're going. First of all, that we're not, we can't just seal the deal on these additional targets being hit yet, because all this is right now. You want to call it what you want. This is still just a stock market correction. It is not a crash. I've issued warning signs, those little crash warnings. All the potential ingredients are there, but that doesn't guarantee a market crash or a big drop. I don't want to use, hyperbole and, the word market crash. I'm talking a big move down. In other words, something that's going to take us down through the recent lows. And what will do that? Well, I think a break of this week's lows, especially if it happens after the post FOMC noise, I call it. Post FOMC noise is immediately following that 2 p.m. Announcement. So really anything after today. Now we could take it out today and keep going. Don't get me wrong, but just remember there's going to be some sharp swings in the market after 2 o'clock today. The Fed meeting. I haven't even talked about FANG earnings because to me, for the first time in a long time, they take a back seat to the FOMC announcement. So that's why usually every quarter when all the big FANGs report within a 2-week window, I'm talking about that and volatility. They've already corrected, so I wasn't worried about a huge drop in any of the big FANGs or the market on what any of the big FANGs reported, because again the markets are oversold and they've already gotten the snot knocked out of them recently. What's really going to determine where we go from here is, or has the potential to, I should say, is what the Fed says today and how the market interprets it. So that's it, guys. Big level. We already hit first target, gave you opportunity to book profits and or add to those shorts. And if you're as I said many times, I'll say it again, if you're a trend trader and you don't want to try to game all these little bounces, sit tight. We have big sell signals here. You may have to ride out a little kickback. You may not. This is a relatively minor reaction so far. So you're still very profitable. If you shorted anywhere up around those multiple shorting ops around 400, you're still 12% up on that position after being up even more. There's the 40-week moving average, which is the 200-day exponential, and then that level there's the bottom of the range. So if you look at it on this chart, and one bit of advice, and again this cuts both ways, is to use set stops or allow your stops to be placed on a daily closing basis, or even if you can tolerate a weekly closing basis. And what I mean by that, it helps prevent whipsaws. Let's say you were going to short the 200-day, which is a 40-week moving average, and we go well above it. Well, by the end of the day, we may come back down and close back below it. So these end-of-day stops help to minimize getting stopped out in a whipsaw. And again, the downside is sometimes you can lose more than if you had a tight stop just above the 200-day intraday period on an intraday basis. But there's your levels, guys. I think it's pretty simple. Here's where floodgates should open. Again, little caveat or asterisk is, with the FOMC noise, we could pierce through there, slightly undercut the lows and still rally. But I think after today, it's going to greatly increase the odds that we move down and hit my next target about 299 and change down there. And that from right now, if you shorted, this pushback to resistance that I showed you this morning, you're talking another 15% profit or 15%, just from a short taken here. QQ or SPY is these are target levels, resistance support levels 426.32 roughly, zoned about 415.51, and I think we'll color this one up yellow because you really want to increase the odds. We're going much lower in the market. I think when 415.50 is taken out, that little shelf of consolidation there, support, that should open the door for a drop down to about 394.50. And that target would be about another 10.5% drop. And again, we're trying to recover that 200-day, and this could just be, and if you look at it this way, essentially last week we just parked on it, right? This week's not over. This week's far from over. A lot can happen and will happen between now and 4 p.m. on Friday. So if you want to look at it glass half full, you're an optimist. You just had the first pullback to the 200-day moving average in a long time, and we may a 40-week moving average if again we're on a weekly chart, and it may be a successful defense because this candle has plenty of opportunity to close back above there, and if so, that's only an intra-week break. And the last time you had a pullback after to the 200 or 40-week moving average was right here. If you bought it and just sat tight on SPY, you made 62% on your money. These were all pullbacks to the 40-week right there. You bought them. They kept you in the trend. So I'm giving you guys everything here. It's not a nail in the coffin thing for the shorts. Don't ever confuse impulsive selling, which we've had in the last 2 weeks, panic selling, to the sky is falling. Again, I've made no, I'm being straightforward where I think we're probably going, but again, you need to get some more check marks to open the door for a much deeper correction and or bear market. Because right now, again, it's a pullback. These are big levels, I think, the 200-day moving averages, and you got to look at SPY and QQQ, not just one of them. And if any one of them, probably give it the benefit of the doubt. Look at the S&P 500. It's a more diversified index. It's closer to being the stock market, and you got the Wilshire 5000 as well. Wilshire's below there, but certainly has the potential to regain that level. And also, you can short a bounce back to that level on the Wilshire. Okay, and just stepping it down to the 60-minute charts, we're at T5, which I should have colored that in. That was hit a while ago. Went down through the fifth target on the 60-minute chart. These were intermediate or near-term targets based on, again, the 60-minute chart, and they were all hit. 1, 2 here, 3, 4, T3 zone, T4, and T5. We undercut it, and we're back testing. So again, let me reiterate. This is an objective short entry. This is a kickback to resistance. It was a kickback to the 200-day simple moving average in the S&P, and is it a kickback to that pretty decent support level I had right there, about 352, which was my fifth target. You had reactions here, and then another one there because you closed on it, and then you gapped down below it. And we've had several kickbacks to that level that have contained it. You can see from this 60-minute chart, there's not a lot up here until we hit T4. So maybe a solid break above here. But again, take what you see today, even before and after 2 p.m. with a grain of salt, technically, because of the, what I call the noise, the aimless, grinds that accompany leading right up to the FOMC meeting, especially the day of. There's a potential downtrend line on SPY that could come into play here. You have a couple reactions there so far, and again, SPY, as I showed you, is at the 200-day, or was just shy of it this morning, the 200-day exponential moving average. Trend indicators are bearish on the 60-minute chart as well for SPY. Quick look at the euro, because again, this is where if you want to use the charts to try to extrapolate or guess which way things are going to go after with this meeting, I'm going to say it's going to go to the Powell doing what he does best. Jerome's easy like Sunday morning Powell. It's just in his nature. He's excessively easy in my opinion, and that of others. Both the Federal Reserve and the federal government, I think, overreacted and overstimulated the economy when COVID hit. I don't think you can debate that. The economy's been on fire. Everyone talks about supply chain disruptions, and I've read article after article said that's BS. This is a demand side, inflationary environment. There's been excessive demand. When you start printing checks and handing everybody, outright checks, and every business owner, no matter how good a year they had, flooding them with money from PPP and all other kinds of stimulus, and then keep rates at zero long after they needed to be, with one of the hottest housing markets in history. It's just, anyways, we can sit here and talk on it all day long. I think he's doing a huge disservice to this country being so easy. But where am I going? I digressed. So this is, again, just looking at the charts, this would indicate to me, I see a bullish falling wedge pattern. I'm sorry, guys. This is the Euro USD. You don't even know what I'm talking about. Euro USD is the Euro US dollar pair. So this chart is essentially when this goes up, it is the euro moving up against the US dollar, right? So that means dollar down, euro up when this chart goes up. And what I see here is a on this time frame at least 60-minute bullish falling wedge pattern. It hasn't broken out. Needs to break out, number one. And again, I caution you jumping on the initial reaction right after 2 p.m. See what sticks. But if this holds, and in fact you have the positive divergence, and you have some pretty good support down here as well, it tells me that the Fed's likely to come out and be more dovish than the street expects, and that would be the case if this breaks out, because that would mean the euro's going up and the dollar's going down. You know, the dollar is going to strengthen against other currencies, particularly the euro, because that's 57.8 or something percent of the dollar index. That's why I'm talking about it here. It's going to go up. The dollar will, if the thoughts are that we're going to have higher, we're going to increase our rates above theirs or faster. And likewise, if the ECB is, rates are implied to go up there against the U.S. rates, you're going to see the euro rally. That's what causes these currencies to move. And there's a first target / resistance, second target, third target that I just added there. If this happens, that should be bullish for silver and gold. Otherwise, hey, things can go the other way. I'm going to get just an update on the Palladium trade. I don't want to get to all my trade ideas, but that was a case of we shorted that yesterday. I did at resistance, but it popped at resistance. It broke out. And so that trade should be stopped out. But this is the thing with the euro. When you look at the daily chart too, you have a break of that uptrend line I just showed you there. We're marginally below it. I'm talking about this one on the 60-minute chart right there. We're marginally below it. Could prove to be a whipsaw, especially if the wedge breaks out. And if it does, then this is going to be a bear trap, aka false breakdown. That's going to be really bullish because it's sucked in some shorts in the euro, longs in the dollar. And so if we can break out, you're going to recover this trend line. And again, that's a 60-minute chart there. This is a daily chart, what it looks like. And so this is what I'm going to watch for after the meeting today. If I see the euro recover that level, go on to hit those targets on the 60-minute chart. And especially, look at that big old primary downtrend line right there. If the euro can break above that, very bullish for gold and silver, those precious metal trades that we're in. And there's some resistance levels as well. So that's kind of one of the things I'll be watching. You can also see the euro on this PPO is crossed above that zero line there, and that's usually going to give you a trend. Bullish trend when you're above the zero line, bearish trend when you're below. And it's been pretty much below the whole time here in that bear trend, but recently made a bullish crossover. So that would be really nice for the gold trade, and that would mean that Powell just cowed down and is despite what he actually says, it's what the street, the professional traders interpret as to really what he's going to do, because that's the one thing about it. I promise you this, I've been following the Fed forever, and they are completely reactive, never proactive, and they're always behind the curve. One more level, and then we'll move on. Let's see, right there, boom. That's a nice resistance, about 113.24 there in the euro. Otherwise, look, guys, it could go the other way. He may be hawkish, and if so, the euro is going to break down, and when this trend indicator is going to roll back down. So these are things to look for, and then that's not going to be. Doesn't mean gold and silver must go down, but it will give them a headwind if the euro is falling and the dollar is rising. Okay, and a quick update, and here's an example when you buy support on a long or you short resistance. I've mentioned the Palladium there at pretty good resistance. It was great resistance, a lot of reactions, but it broke out, and so that's where that trade was stopped out. And this is why again I like futures, because the stop, my stop was right up there, got popped overnight, and if you are in PALL, let's look at that real quick. Then what happens is you're subject to a gap, an opening gap. Let me find that chart there for you. PALL. And boom. See that? You can't. This is where futures are advantageous. you can't sidestep that gap if you're trading an ETF. That was a 4.5%, and it may have bypassed any well-placed stop in between there. And I just want to say, if you gave it room, and I may add this one back, is this is the whole reason for shorting Palladium is well, I've got another chart I'm going to show you, but it called a major top on it back here. And it's still, in other words, it's called the end of a bull market in it. And we have technically, I guess, if you look at it this way, we've had a drop of so far 40, yeah, 50% right there. 40, yep, 50, 49%. So, the call was correct. That's a bear market, and I think we're still in a bear market with a lot more to go. But as mentioned back here, we put in bullish divergence. That was a catalyst for this move. But look, this is big resistance right there, right now in Palladium. So the breakout that we just had on the intraday chart may prove to be a false breakout, and I just want to mention that. So if you gave it room, or if you're looking to short, wait for a failure back below that level I just showed you here. Let me show you real quick. Palladium, where's my PA? Wait for a break back below 2140, and that should do the trick, because then this whole thing here will have proved to be a false breakout right there. So, and then again, jump back to that chart here. There's big resistance right up there, about 2190. I should be clear. We need to break below that. This is an end of day chart, so it's going to show a no, not end of day. Is this one end of day? Yes, end of day. I'm sorry. Excuse me. This is end of day, so we're going to have a little pop above there, but it's still big resistance, and we're oversold. And in a bear trend, once you're oversold, that's usually it. Oversold is typically one and done. In a bull trend, oversold tends to become more oversold or stay oversold for an extended period of time, and then you get buy pullbacks. I'm sorry, overbought. Guys, up here is overbought. Sorry, I'm going too fast trying to get all this in. And then in a bull trend, you want to buy pullbacks oversold. But when you have a bear market like this, oversold tends to become more oversold or stay oversold. Just like here, we're in a bear market, right? This is what I talked about, called a top here. That is, see how these persistent, you have more frequent oversold conditions, and it tends to become more oversold. The only time you really want to cover up those trend shorts and go long is if you have bullish or positive divergence, which we did right there. So that's it, guys. I want to say we're back into resistance, and I have one other chart to show you on Palladium before we wrap up. This one here, this is the weekly chart of same thing, Palladium futures, and this was a case made back on the site when back here, and I gave you this long-term target back on 8/31 to a target of 1100, which I still think we're going to. This was the case behind that. We had a nice on the weekly big bearish rising wedge pattern. And again, we're down, what was it, over 50% I just showed you, or about 50%. And so this is it. It was a breakdown, a back test, and this looks like a counter trend rally. So I still think we're going lower. But again, you get overbought, even in a bear market, and you usually bounce. And that's what happened. We just hit overbought. So that one will be revisited, or I just showed you the levels to watch and to reshort if you stopped out or if you didn't take it. And then let's wrap up with gold and silver, because I still like those two. And again, don't go in too heavy into an FOMC meeting, or you could get burned. But you have these. This is a 60-minute chart of GC. To me, big level still remains about 1840. We're trying to pop it, but again, nothing's going to happen right in front of the Fed. It's unlikely going to have a breakout. But if we can pop that with conviction, especially those old highs, that should be all she wrote. I believe gold will have embarked on the next leg up in the new and in the existing bull market. We've been in a year-long or so consolidation range in a bull. That's what I need to see. Otherwise, look, if the Fed, depending on what the Fed does or what the market takes, there is pretty big negative divergence. This is why you can't go heavy right now in gold. You have a lot of negative divergence there, and that could send gold back down, possibly to the bottom of the range, and that's just right? We've been kind of like an EKG in this range. So we'll wait and see, and I'll certainly follow up after the announcement and over the next couple days. Again, it's not just what happens today, it's what happens over the next several trading sessions. And then last but not least, I want to update silver, which I've overweighted relative to my gold positions. Silver right here, still holding that uptrend line right there, and this is what I favor. Move up here. You've got nice support there. If you want to buy it at pull back to 23.4, about 23.45. Worst case, do we come back down to the bottom of the range? I don't think so. I wouldn't like to see it. It's been a while we've been grinding around. This is my preferred scenario, but we'll just have to see how things go today. All right, guys, I'm going to wrap it up here, get the video out to you, and again, I'll do an update, of course, after the Fed. Maybe get something out to you before then. Yesterday, I cut out after the last video. I took my own advice. You're going to see a lot of whipsaws, as you saw. You've seen the market go up, down, up, down. There's money to be made on both sides. Just expect a little bit more of that, and then we kind of go into that holding pattern. And then 2 o'clock, things maybe get a little crazy for a bit, and maybe over the next day or two. And again, let me just loop something back and not beat a dead horse. I put those talked for weeks, even months now, about all the warning signs in the market, and they're still there. So there's still the potential for, as big as a drop that we've had over the last few weeks, there's a potential for a much bigger drop. There's no guarantee, but the potential is there. So if you start to see it going that way and those support levels give way, I think there's still a lot of profit to be made potentially, and I think it'll happen this year, whether or not we bounce now for a couple of days or a few weeks back to some of those upper overhead targets. But there's a lot of evidence in my book that the market may have topped, including but not limited to what I'm seeing here all the way out on the monthly time frames with these PPO trend indicator. I mean, it's already been accurate. You can say what you want about it, but we've already had a better than an 18. No, what was the drop in the Nasdaq? I'm sorry. The drop was so far about 18.35, close enough. 18% drop. So that was something I warned back early in the month when we crossed over on the PPO. And now, no matter what, you're all but guaranteed to have that crossover in play right now on QQQ. And look, it hasn't even happened yet in SPY, but it's getting close. So if we have another leg down, we're going to have this trend indicator flip over, and I'm going to have some of my other long-term trend indicators. We're going to have death crosses on the major averages. I told you about the death cross in the small caps right now. We need to see it in the large caps. I'm talking about the 50, 200-day moving averages. And so those will be additional check marks. And, just, again, don't underestimate how much downside potential there is in the next bear market. And it may be upon us. So anyway, let me wrap it up here. Get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.